All right, everybody. Hello, welcome to our Convergent Advance Your Wealth video series. I'm Homer Smith, founder of Convergent Wealth Partners. And with me tonight is Mike Green. He is the chief strategist and portfolio manager at Simplify ETFs. For those of you who don't know me, I'm a private wealth manager here in the Seattle area. And we primarily work with private business owners and successful families, helping them navigate the complex transitions that come up in their life, from the growth to the sale of their business to the transition of their assets to the next generations down the road. And part of our model is really building out what we call a virtual family office, where we're the coordinator of experts to find all of the right pieces that need to fit together to optimize our clients' financial worlds, including on the investment side. So I'm really excited to have Mike with us tonight, as I mentioned, chief strategist and portfolio manager with Simplify Funds. And what they say a lot of times is the most successful people surround themselves with people that are smarter than you are. And, in my opinion, Mike is one of the smartest and most insightful people that we have in the financial space. And the research that he is doing and the insights he's bringing to the table, I think are really important. So just really grateful to have Mike and his Simplify team part of our Convergent team. And Mike and his team were really instrumental about 18 months ago, as we were starting to see some of these issues developing in the economy, to build out what we call our all-weather portfolio construction approach. And so, again, excited to have Mike here tonight and share some of his insights on what he sees happening. So before we jump into everything that you can bring to the table tonight, Mike, maybe just for those that don't know you super well, a little bit on your background and ultimately how you ended up at Simplify.
Sure. So first of all, thank you for having me. And it's always great to hear, how people are choosing to use our products and our advice in their process. So I'm thrilled to be here and thrilled to help educate the audience in terms of what we see going on, et cetera. In terms of my background, fairly standard for the industry. I actually started coming out of business school and undergrad, went into management consulting, built up an expertise focusing in the areas of M&A, mergers and acquisitions, advising in particular corporations around strategic planning opportunities. That led to the recognition that there was an opportunity to create valuation tools that could be used by everyone from other consulting firms to asset managers. Built that business from the period of 1996 through 2000, sold the business in 2000 to Credit Suisse when their credit was still good. And then transitioned over to the buy side, where I was incredibly fortunate to have the opportunity to manage across multiple asset classes, everything ranging from small cap equities to true global macro in the rates and derivatives space. What I'm most well known for is the work that I do on market structure and in derivatives. And in particular, I'm sure we'll spend a little bit of time talking about this, the dynamics of the growth of passive investing and how that's influenced market behavior, market structure, and helps to explain some of the phenomenon that we see in markets today, everything ranging from rising valuations to increasingly illiquid and what would be described as markets that are discontinuous in nature. They basically gap from one place to another.
Great, thanks for that. And again, looking forward to all the areas this might take us tonight. So just starting out, markets are, most of the people here, or a lot of them are clients of ours. They've seen, pretty a different year, I guess, than we've seen in recent years, with, S&P down about 25%-ish as we're recording this, NASDAQ 35%. But I think most importantly, an aggregate bond index down 15%, and long-term bonds, in many cases, down as much as the stock market. And I think that the biggest challenge for many investors is they're used to that bond part of their portfolio being the ballast and kind of hanging in there when everything else is going wrong. So kind of from your point of view, what are you seeing now? We're, over 9 months into the year. The Fed has been doing a lot throughout the year. What's been their role, and kind of how do you see things from your perspective on that?
Well, so I think you hit on the really critical part, which is that the equity markets, as interesting as they may be, pale in comparison to what we're seeing in the bond markets. The really exceptional behavior is coming out of the bond markets. And this has been a really interesting year from my perspective, because among other things, it's been an opportunity to prove out a theory that myself and a few others had floated about market behavior that I think suggests that there's a very different mechanism at work than most think as it relates to bond prices. And just the simplest way to think about the way most people think about it, they put on the valuation lens and say, because interest rates are higher, therefore equities are worth less. We're discounting out future value. We do a discounted cash flow analysis. If the interest rate goes up, that therefore should cause a contraction in the valuation of the security, and its price should fall. There's a totally different way of thinking about it, though, and somebody like yourself who runs products that combine bonds and equities is probably much more intuitively aware of this dynamic, which is that when bonds and equities are put together in a portfolio, the way that they behave has a huge impact on how much risk you can put in place.
Yep.
So when bonds and equities behave as protection for each other, in other words, when bond prices go down because interest rates go up, and the reason why that's happening is because economic growth is accelerating, financial conditions are loosening, and we're creating conditions under which equities are outperforming, that ultimately creates a dynamic where the expected value in nominal terms, because you actually don't care about inflation in this analysis, but the expected value to bonds is positive as long as they're paying a positive coupon. And yet they offer hedging characteristics to your equity portfolio. And therefore, I can own more bonds and more equities if they both have positive expected return and negative correlation. If they are positively correlated, which is what we've experienced basically for the past 2 years, then all of a sudden they're treated, instead of as complements, which is the economic term for what I just described, they're treated as substitutes.
Yeah.
So in the simplest form, you can think about an environment in which if both bonds and equities go down together or go up together, I'm forced to make a choice. Do I want to own bonds or do I want to own equities? But if bonds go down while equities go up, then the answer is, well, why not both? Right? I want to own both. And instead of a portfolio that's built 60-40, for example, I decide the right way to construct my portfolio very well might be 100-150, right? So I'm levering my bond exposure, increasing my equity exposure. I'm taking more aggregate risk because I've got an embedded hedge in my portfolio. And I think the unwind of that is a huge explanation of what we've seen so far this year. So like those who follow my work will know that I've continually said we're not yet seeing passive redemptions. We're not seeing Vanguard clients sell. We're not seeing the bogleheads throw in the towel and say, you know, all right, I'm out. I can't take it anymore. We're actually seeing the opposite. They continue to buy. But what we are seeing are the institutional users of those same products, right? So somebody who's trading SPY or E-mini futures to very rapidly gain exposure, they're taking down their exposure quite significantly. And this is one of these really interesting situations where we don't really know how this is going to play out, and the importance of that dialogue, right? The idea that what we're really seeing is a de-risking because of the loss of hedging associated with bonds suggests that the level of bonds really doesn't matter all that much.
Yeah.
Right. And broadly, I think that's true. I think if we actually were to see the Fed decide to respond and start to lower interest rates to reduce stress on the market, even with the very high valuations and much higher interest rates that we're experiencing today, we could very easily see a significant rally simply based on that flipping back.
So speaking to that, so part of our title to the event this evening is around the Fed and their impact and what might come from that. With all the things going on, and obviously we're in a unique environment of how quickly they've raised rates and going from less than 1% on the 10-year Treasury to close to 4%, and obviously the 2-year being even higher. What has been the impact of the Fed, and I guess what are their options from here? You said they could pivot, and all of a sudden that could have a different dynamic on the markets. What if they have or feel the need to keep the foot on the gas?
Yeah, no. So I think that's a really good question. I've got a couple of slides that are probably worth hitting on that, right? And so the first section of the presentation I put together today is called U.S. Markets from Fed Up to Recession, right? I wrote about this, and I'm happy to share with your audience and provide it to you. You can pull it off of my Twitter profile or off of my Medium link. I wrote a piece actually about this dynamic. And, what is the Fed trying to accomplish? And what they've told us that they're trying to accomplish is by raising interest rates, they're hoping to slow the economy enough that it allows price pressure to recede, basically prevents inflation from becoming entrenched. I think the problem with that approach, the reason why I'm so concerned about that approach is that there's almost no evidence that raising interest rates affects consumption, right? And I just want to be very clear on what that means. Nobody goes to the grocery store and says, should I buy ice cream or not? What is the what is the Fed funds rate? Like, I guarantee you, absolutely nobody is making that call, right? But what they very well may do is say, you know what, the Fed is very aggressively raising interest rates. Therefore, I'm not going to buy a new house, or I'm not going to put a down payment on a house that hasn't been built yet in the hopes that it's constructed. Or if I'm a CFO, I'm going to delay investment in a new production facility or in onshoring my operations, making the necessary changes that I realize have to be made because the Fed is sending me a signal that they're trying to slow the economy down, and I don't know how far that goes. And so, the actual mechanics, the relationship between interest rates and consumption is what's called the Euler coefficient, EULER. There is no evidence whatsoever. The empirical evidence, if anything, suggests the opposite, that raising interest rates slows consumption. I just want to be very clear. Buying a car is investment. Buying a house is investment. It's not consumption. Buying a TV is consumption. It doesn't have a long enough life for you to really generate a return off of it. It doesn't help you get to your work, et cetera, et cetera, et cetera, right? Buying Campbell's soup is absolutely consumption. We know these things, unless you use it to deface, Van Gogh prints in Europe.
Right.
Then it's divestment, or disinvestment. But the underlying dynamic of what we're experiencing right now is the Fed is trying to use tools to accomplish an objective that I would just broadly argue are not designed for that. And they run a very real risk of exacerbating the problems that we're currently experiencing by slowing down investment, so that when we try to start up again, we're actually further behind the curve than we are today. That's my single biggest fear right now.
So we've seen some charts from some of the people that we follow from a research perspective, and they talk about the wealth effect. I think you're speaking to that, where they see that with potentially declining housing prices and asset prices, that it could filter into spending. But what you're saying is, if it does, it filters more into much larger purchases like homes, cars, larger investments. It doesn't necessarily filter into day-to-day expenditures.
Right. And I would actually suggest that even when you talk about that wealth effect dynamic, the far more likely outcome of a wealth effect dynamic is I don't sell my house and retire to Florida, freeing up that house in a growing and productive area for a young family that might want to move in, right? I find myself trapped in that house. My mobility is reduced. You can go a step further and say, if I can't get the price for the home that I require in order to fund my retirement or my convalescent care, I could very well choose, instead of going into an assisted living facility or into a nursing home, I could choose to stay at home and incentivize my children to not participate in the labor force by offering them access and the use of my home, right? We have a name for that. We call it Italy. Right. That is what the Italian story is all about. The home ownership rates in Italy are exceptionally high. Why? Because two people have one child. That child never leaves the house, gets married, moves out, etc. And guess what? They inherit a house, and therefore you have high levels of home ownership, even as you have a remarkably stagnant economy, right? Where young people in particular, have a much higher incentive to stay in place and inherit the home than they do to obtain proper training and to move to a place where they can be employed.
Got it.
Right. The second thing that I think is concerning, and this also goes back to the housing market, and I just want to hit on a couple of slides on that. I'm going to skip this one. I'll come back to it. So first, we've known for a very long time that housing is the business cycle, right? So prior to the global financial crisis, Ed Leamer actually put out a piece from the National Bureau of Economic Research, the entity that is responsible for declaring a recession, labeling housing as the business cycle, right? No surprise we were going to have a recession associated with that. This time around, we're doing the same thing. I think the thing that surprises me most is how emphatic people are that what we saw happen in the housing market was the fault of the Fed, right? That home prices going up a lot was driven by the Fed. And I've tried to draw people's attention to a piece that just came out of the San Francisco Fed that emphasizes something I've been saying over and over and over again, which is that what we really saw in the pandemic was a dramatic increase in the utility of homes, in particular single family homes, where the house went from something that you inhabited from 6 p.m. at night until roughly 8 a.m. in the morning to something that you were occupying 24/7. You began to work from home, you schooled your children from home, you did your entertainment at home. All of that means that the value of a house rose, the utility of a home rose, and we should expect an increase in demand and higher prices, all else being equal, associated with that. Now, the San Francisco Fed only examined the work from home dynamic and came to the conclusion that about 60% of the increase in home prices could be completely explained by that one factor. Right. And I'm going to submit to you that the school at home, the entertainment at home, and the sheer fact of safety, the fact that you were no longer exposed to somewhat random strangers who could kill you in the conditions of a pandemic, right, by their mere breathing on you through a porous mask, right, that underlying dynamic, I would argue, explains almost all of the home price increase that we saw, potentially more than 100%, like as crazy as that sounds.
Yeah.
Now that we're reversing all of that, we should expect home prices to fall. And the problem is that the Fed is blasting both barrels at the housing market exactly as this fundamental retreat is underway. So we're suddenly returning to the office. 2022 is the first year where kids are back at school in a permanent fashion, and entertainment options outside of the home are exploding, right? Unsurprisingly, people want to get out of their houses, and the value of their home is significantly less. And now, of course, the Fed is showing up and just absolutely obliterating everyone with interest rates. And so I just want to remind people what actually happened in the pandemic. The Fed targeted mortgage rates by lowering the Fed funds rate and by buying mortgages. What that actually meant was that the effective component was mortgage rates fell by about 75 basis points from a historically low 3.5 to about 275. And importantly, it kept credit flowing despite high levels of unemployment. Right now, that's actually the really critical component, because if you'd gone and you'd tried to purchase a house while you were unemployed in the early stages of the pandemic and trying to get out of a major city where you were locked into a lease that you'd then walked away from because you were so terrified of living with your roommates, nobody would have lent you money borrowing it without the support of the Federal Reserve, basically saying, we're going to make sure everybody's capable and covered. Right? What the Fed did was kept the flow of credit going. Now, that may have been a mistake. We can certainly argue whether that was the right choice or not, but that's what they actually did. Now, on the flip side, what they've done is they've raised rates by 400 basis points in the mortgage space and stopped the flow of credit to mortgages, despite the fact that unemployment is near the lowest levels in history. That's a far more interventionist action than what we've seen on the other side of it. And I find it candidly very confusing that people are horrified at an interventionist Fed when it's trying to make things better for people, and yet somehow they revel in the dynamic of, the Fed shutting off the economy and creating conditions that are incredibly punitive. I genuinely think that there is a significant component of it that's almost like our Protestant past as a nation, right? We want to be locked in the stocks and whipped for our collective sins.
Yeah.
I don't understand it. I certainly don't have that characteristic, but these are the facts of kind of what's underway.
And so I don't want to jump ahead if you're going to cover it. And I think that the housing stuff we're all feeling it, because those that are looking to buy a new home are now experiencing the higher rates, and especially the younger generation, that first-time home buyers in particular. From a lot of what I'm seeing, the housing market, we're not likely, and you can correct me if I'm wrong, at least unless things change dramatically, we're not headed to an 08, 09 type dynamic with housing. Where our bigger concern might be is what happens if rates keep rising and we've got all these corporations that have all this debt that needs to roll over. I don't know if you were planning on touching that as part of this or somewhere later, but how does that fit into this dynamic? Or you can cover that later or go back to it. But I think that's something that is something that I'm starting to really worry about and think about.
Yeah, no, I think you're hitting on a couple of really important components. One, I don't think that this is like '08, right? So in '08, the difference was that there was an extraordinary quantity of homes that were significantly underwater and owned by the banks and therefore needed to be dumped onto the market, right? Effectively, they had collateral in the form of houses against mortgages. When the mortgages went bad, the collateral was handed back in a form of jingle mail, right? So the keys go back, and then they say, well, we're not in the business of managing this. We want to sell it and get whatever recovery we possibly can. That created a ton of distressed sales. Now, we may see distressed sales in some areas, right? So as people struggle to find employment, if the economy weakens significantly, and I'll show reasons why I think it's going to at least weaken from where we are today. Um, when you have that type of dynamic, the most likely scenario, again, is an Italy type scenario where essentially no homes go on the market, right? And those homes that do go on the market have something so terribly wrong with them. I mean, I encourage people, like, pull up homes available for sale in places like Italy or Portugal, et cetera. You don't have the same selection dynamics that you have in the United States. There's much less new construction. Portugal, a little different than Italy, for example, right? Nobody, waits with breathless, with bated breath for the report on housing starts in Italy because there are none.
Right.
Right. So, that's the risk that we run in this country right now is that we move ourselves to a new equilibrium in which people basically don't sell their homes. They don't move. They don't relocate for job opportunities. Their children, make a very calculated, uh, uh, decision that they're going to stay and take care of you and keep you out of the market solution for extremely costly elder care, and replace it with they get to inherit the family home.
Yep.
Right. And by the way, inherit the mortgage that you got at 275, right? 275 basis points. That's a real risk. And that would be an incredible tax on the innovation capability and potential of the US economy. Trying to think of, the second component is just, so far, I would argue that people by and large have been very insulated from the impact of the Fed hiking rates. And the reason why they've been insulated is the pace of the business cycle. And so if I look at housing, and again, going back to Lemur, that housing is the business cycle, what we've seen so far is, potential homebuyer traffic has collapsed in a manner that's even more rapid than what we saw in 05, 06, 07.
Yeah.
That traffic in turn leads to reduced home builder sentiment and a reduction in permits. We're actually now seeing negative permits where permits are being abandoned and expired. So the net quantity of permits that are outstanding is beginning to fall. Once permits begin to fall, about 6 months later, houses under construction begin to fall. And once houses under construction begin to fall, guess what happens to the people who were building those homes? Their jobs start to go away. And we're increasingly hearing this where home builder crews are basically finishing their last job and then it's nothing, right? There's nothing left for them to do. The layoffs will come if that persists. I also think that there's a very real risk that the Fed can't undo that damage anytime soon, right? This is going to take at least one full season before people turn around and like, all right, I'm really confident in my ability to buy or sell a house at a reasonable price. My gut tells me that this is going to be a more difficult and slower solution. I don't think it's exactly like the global financial crisis and the housing collapse in 06, 07, 08, because we don't yet have that quantity of distressed assets. But this is a significant warning sign. I mean, this would suggest that you're looking at a fall in household in construction employment, somewhere in the neighborhood of 30 to 40%. And this is one of the areas that has among the highest multipliers in terms of activity in the rest of the economy, right? You buy a house, you hire a nanny, you get somebody to do your lawn, you have somebody do the realtor is employed, the realtor hires a stager for the sale of the next property, et cetera. All of those are huge multipliers across the space that I think are inevitable to hit.
Got it. That makes sense. So not necessarily an 08, 09 crash yet, but the way things are setting up, it could still be a very challenging environment.
I would suggest that what we've seen so far has largely been confined to the financial markets. And now the question is, does the real economy start to suffer more than the financial markets for a period of time? And my hunch is yes.
Yeah. Got it. So I want to go back to something, and again, I don't may not be fit into the presentation that you have or a slide. I was watching something you did on CNBC back in June, and you were speaking to the zombie companies in the Russell 3000, and already there were 700 of them or so back in June.
Yeah.
Rates were still, in their early
rates were positively low back then. Yeah.
And it was almost 25% of the Russell 3000. How do you see that playing out if the Fed had, for whatever reason, inflation being higher than people would like it to be for a longer period of time, and they keep the foot on the gas? What's the risk there? Have you, I know that those companies are already zombies. What about the ones, the next 700 above them that are maybe just barely investment grade that, if rates stay high and they have to roll their debt at higher rates, what's the risk in the corporate debt market?
So, I mean, I think it's hard to pretend that it's not significant, right? And you hit on a couple of really important things. There's effectively, there's three things that we need to consider, right? And the first is the framework of Hyman Minsky. And so Hyman Minsky is famous for his stability begets instability framework, basically helping to explain panics, crashes, et cetera. We just saw a perfect example of this in the pension plans in the UK. And so most people have looked at the behavior of what's just happened in the UK, in which there was a crisis in UK sovereign bonds where pension plans, thank you for taking that off, where pension plans that had tried to address the low level of interest rates by seeking levered exposure to higher interest rates along the curve. And just to mechanically explain what was going on, you were running negative interest rates at the very front of the curve in Europe. That created conditions under which you could borrow, effectively sell a 1 year or 2 year bond, use the proceeds from that to purchase a 10, 20, 30-year bond, run short one, long two of the other, or 5 of the other, or 10 of the other, right? Depending on the leverage that you wanted to put in. The problem, of course, is when the interest, there's two things. One is what you're using to borrow is your collateral. In this case, I own 10-year bonds. That's the source of my collateral, right? So as those fall in value, I potentially have to put cash up. The second is that in a pure derivative contract, I'm typically looking at the spread between those. And because we've hiked interest rates at the short end so rapidly, we've seen an inversion of the yield curve that turns that positive cash flow characteristic or situation potentially into a negative cash flow situation. And that's what was playing out. And so these schemes, and again, remember in the UK, a scheme just means a business plan, right? It doesn't mean that you're being scammed out of something as it would in American language. These schemes shifted from being self-funding and viable to being what Hyman Minsky would describe as Ponzi, right? They require additional inflows of capital in order to remain solvent. It's not that their business model suddenly became bad. It's not that the underlying theory of their business was flawed or anything else. It's just because of the behavior of central bankers, their business became unviable, right? And I think that's exactly what we talk about when we describe zombie companies. So the zombie companies, as long as interest rates are extremely low and refinancing is easily available, they can continue to sell off pieces of their business, or they can continue to refinance the debt by accessing the capital markets, preventing them from facing a crisis, right?
Yep.
Now that opportunity is being taken away. The offset to it is that when you issue bonds or you do a loan, right, and you do a fixed fixed for floating swap or a floating for fixed swap, which is fairly common for these entities, you've locked in your cost of capital for a period of time, right? And you can pretend that everything is fine, right? It's the ultimate example of kicking the can down the road, right? But the minute that they're forced to tap the capital markets, the minute they're forced to face the refinancing of that debt, the cost of the next piece of paper that they issue is so high that their business model is no longer viable. And so it's very plausible that within the fixed income space, within the credit space, that we experience something very similar to what we just saw in the UK.
Yeah.
And that is a very clear risk that, again, is extremely non-linear in its characteristics, right? We have a period of grace because in the pandemic, everybody that could refinanced at exceptionally low cost of capital. If business profitability maintains itself, very few of those businesses are going to have to refinance for a period of 1 to 2 years, and that creates some comfort and some safety in the credit market. But if the Fed slows the market down dramatically, if the economy deteriorates, then those businesses that were making money on an operating basis, even before we start to think about the dynamics of their financing, could see a deterioration of profitability, start to lose money, need to obtain funds more quickly than we otherwise would have expected. And by the way, as they face that, what are they going to do? Well, they're going to kill any investment plans, which is exactly what we were talking about before, right? So the relationship between investment, which we desperately need, and higher interest rates proves to be our undoing in those conditions.
Becomes self-fulfilling, effectively.
Right.
Yeah. So I know we'll talk about, as we were talking before we jumped on, that, there's so much negative sentiment in the market, and there's probably good reason for that. And I think you have some more to share on why everybody is so bearish. So maybe why don't you touch a little bit more on what do we have ahead? What's the risks ahead? And then I think we could touch on maybe why we should be thinking about the other side of it as well.
Yeah, so I think that there's a couple of things that are really, kind of critical. I mean, we all know why everybody is super bearish, right? We've gone through a period where household savings, corporate savings in the form of excess profits were inflated by extraordinary amounts of government largesse, and support for the credit function, as I described, for the housing market, the corporate credit market, et cetera, coming from the Fed saying effectively, we'll buy everything, don't worry about it. We're going to make it through this process. Now, as that's withdrawn, you face two separate components. One is a reopening of the economy that is stressing the supply chains. And, we've seen this impact us through much higher prices of the goods and services that we buy in an open economy versus an economy that's been closed. The closest parallels that we have to that, for example, are the transition from wartime economies to reopening in domestic economies. And the behavior we're experiencing is almost identical. I'll actually show you some charts on that in a second. The second component is that it's very obvious that everybody should be super bearish because markets are down 25%, right? And so, you're a moron if that doesn't make you bearish, if it doesn't make you concerned, if it doesn't make you fearful for what's potentially ahead, particularly because we actually have not yet begun to experience the teeth of the recession that, as I'm describing to you, is pretty much built into, pretty much baked in the cake, right? I like to joke that, recession secured, congratulations, right?
Yeah.
To steal the Elon Musk Tesla financing line. So, I think it's very easy for people to see that. I think it's very easy for people to see the fractious nature of our politics and the fact that we're being divided by things like social media, et cetera. I think people feel very frustrated under these conditions. It's very easy to label, depending on whether you, joined us right after watching Rachel Maddow or right after watching, Tucker Carlson. Depending on your political alignment, you're horrified at the existence of the other party and the inevitability that should, Democrats be reelected, that the world will come to an end. And the only thing worse than that is if Republicans are elected, and then the world will come to an end even faster, right? The simple reality is that a pox on both houses, and we all know that, and that's part of our frustration, right? The last thing that I would just broadly point people to is that the end of history, the Francis Fukuyama unification of the world under the U.S. as the unipolar hegemon, is very clearly fraying and under threat in a way that feels terrible. Now, I also will point out, though, that is one of the things that makes me most hopeful and most afraid not for the reasons that most people think of. So I look at the great competition between China and the United States, or Russia and China together in the United States, and actually almost laugh at how comically easy we're making beating them look. Right? I mean, with the stroke of a pen, we managed to get basically the entire Chinese chip industry to quit, right? So all the experts have now quit and started to come home. By the way, we did the same thing to the Soviet Union in the early 1930s when we suspended diplomatic relationships on the back of purges and drew back all of the Western expertise that had gone there as sympathizers of the Great Revolution of communism. We're seeing the same thing play out with Russia, where I don't actually care who blew up the Nord Stream pipeline. The simple reality is Europe is not moving back into a symbiotic relationship with Russia, even if Russia were to experience a tremendous regime change, right? We've effectively reasserted the US's control over Europe and made Europe into a vassal state. Japan is very clearly a vassal state at this point, in which they rely on us for protection, they rely on us for energy, they rely on us for food supplies. This is not a great situation for the rest of the world. Whether the US chooses to use that power for good, right, or for self-aggrandizement, I mean, it should be very clear that, there's a temptation to use it to extract greater good for Americans in a punitive fashion. I think that's one of the great risks that we face, that effectively we are finally beginning to enter the American empire in a way that is far less munificent than we have experienced up to this point. And people often misinterpret my comments on this as celebrating that. I actually want to emphasize, I think that's an extraordinary risk with potentially quite negative ramifications, akin to the emergence of the Roman Empire versus the Roman Republic, right? We lost democracy and a representative form of government, give or take, for 1,000 years on the back of that type of dynamic. I'd hate to see that happen.
So that's a long time. I mean, there's short-term implications of that. That's also going to play out over the next years, decade,
right,
I assume. And how is that, if at all, directly, like short-term, right? So what everyone's so bearish, all that political, socioeconomic stuff is going on around us. The recession's baked in, as you say, and I think all the data we look at would agree with that as well. What is stopping us from just slowly churning down into an 08, 09, 50% decline in the market? What would prevent that?
So I think the biggest thing that I would point to, and this is, one of the dynamics that for those who watch my stuff, hopefully they're familiar with it. One is we've already begun to see, so we're now roughly 2 years into this bond equity correlation having flipped. We're seeing significant de-risking coming out of the institutional space, whether that's in risk parity strategies, vol targeting strategies, et cetera. So, one of the things I track very actively are vol targeting strategies that reduce their exposure to equities or bonds based on a realized level of volatility, right? They're effectively trying to maintain a constant realized vol. These are very frequently used by insurance companies, et cetera. They've cut their exposure down to about the 7th percentile of history already, right? Maintaining this 30 vol means they run super low exposure. In a perverse way, that means there's nobody left to sell, right? We see the same thing if we go into the long short community, the hedge fund community, and to a lesser extent, other areas of the alternative space, things like CTAs, et cetera. There are already significantly short bonds. They're short equities in terms of a trend dynamic. And as a result, we've seen positioning. Stevie Cohen at the Robinhood conference, Stevie Cohen of Point72, and before that SAC, made this point as well. Everybody has reduced their positioning down to near record levels. Mike Wilson at BAML, I think it was, highlighted in his work on looking at flows and survey positioning that cash levels are already above the levels from 2008, right? People have reduced their gross positioning significantly. Now, the one thing that we haven't seen is any sign that the passive flows that go into 401ks, et cetera, are slowing down. Now, those can reverse on a significant enough recession if unemployment were to spike, particularly amongst the young, so that contributions into passive go away. But we have not yet seen that. And the thing that scares me to the top side, right, that I just think people are underappreciating as a critical risk is if for some reason these discretionary players on the institutional side decide that they want to either cover shorts or buy back into the market, there's nobody to sell to them.
Yeah.
Right. And so this is the same concern and lament that I was making for people in March of 2000 as we hit the lows. There's nobody left to sell unless you get Vanguard to sell. Right. And there's absolutely nothing that says that Vanguard is going to sell. If anything, we're seeing more and more slavish devotion to hold the positioning, behave along the lines of a target date fund, et cetera. Target date fund glide paths are being pushed out with higher equity exposure. The regulatory framework is improving is the wrong phrase, but is changing to make less and less required sales out of tax advantage products like 401ks and IRAs.
Yep.
And so I operate under this generalized level of fear that says, if we try to change this positioning and go back into markets for any reason whatsoever, who's going to sell to us?
Yep.
Right. And that's a concern. Right.
Yep.
And there's also, other areas that I would hit on, look, the overall behavior of inflation is behaving almost exactly like the prior models that we have. So where we have seen an economy shut down and then reopen to allow behavior in a different way, right? Wartime economies. We shut down, we switch over to defense production, then we reopen and we say, okay, now we need to make sure that people go back to, getting all the stuff that they needed. We saw those as hugely inflationary experiences. November 1918 to June 1920, 17.3% annualized inflation over that time period. The recession that followed that, very similar to the one that we're experiencing now, in which the Fed didn't raise rates, but we saw everything slow down as the stimulus from the government left the system, we saw deflationary conditions. And those tend to be net positive, right? It means people have more spending power than they otherwise would have. If I look at the much more detailed data that I have available for the 1940s experience, and I use a CPI metric that is remotely close to what we had then, again, it's almost identical behavior that we're experiencing, right? So just again, to orient people, in 1945, if you were a housewife buying food, you didn't get it delivered from DoorDash, right? You went to the store and you bought flour and sugar. You bought things that are close to raw commodities. Clothing was roughly 2.5 times as much of the index as it is today. Food consumed at home was nearly 30% of the index, right? So all the things that make up what we call the flexible CPI behaved exactly as they're behaving this time around. The one thing that isn't behaving the same, I would point out, is that the 10-year interest rate, they did not change it at all. Yeah. Right? The Fed looked at this and said, this is a natural byproduct of an economy that has been shut down and now needs to retool and reopen. Information content of relative price changes is really important in that process, and we're going to respect that. This time around, I would argue that by interjecting interest rate volatility into the problem, we're potentially making it much worse.
How does deglobalization now play into this? So that's a lot of the story you hear is, okay, we got to re-onshore all this manufacturing and everything that we globalized out, which led to a lot of this disinflation, deflation over the last 40 years. How does that fit into that story?
So one of the things that I guess I would highlight for people is, if I look at the last 40 years, with the exception of really the last 7, right? They really haven't actually been disinflationary or deflationary. We've experienced low and relatively stable inflation, but the entire period has been relatively inflationary versus historical periods. This is, the people that will point to the, inflation adjusted price of the dollar and say it's fallen 97% in purchasing power, to which I always respond, yeah, boy, it was really cheap getting chemotherapy in 1900, right? Our purchasing baskets have changed remarkably. The things that we used to consume, if I came to you and said, how much would you pay for this saddle? You would literally look at me and be like, I'll pay it pay you to take it out of my house, right? That's really what you're trying to accomplish with a measure like CPI or a price deflator like PCE. So we have experienced inflation, but it has been inflation that has been non-determinant in terms of our behavior, right? Again, very few people spent the last 5 years going to the grocery store and saying, should I buy ice cream because it's gone up so much in price? Now, perversely, we've experienced exactly this. We've seen the price of ice cream rise. And all of a sudden people are saying, should I buy the ice cream? I'm really unhappy with the fact that my ice cream's gone from $2.99 a half gallon to $5 a half gallon. Those are all things that we're seriously thinking about. And exactly as you would expect with those price signals, guess what's happening to alcohol consumption? Guess what's happening to ice cream consumption? Guess what's happening to all the things that, candidly, we probably shouldn't have been consuming nearly as much as we did over the course of the pandemic? They're falling.
Yep.
Right? That means we're fatter and less fat and less fun than we might otherwise have been. But these are the natural outputs from price signals. The other thing that I just want to remind people is even all of the things that I just talked about belie something else that's going on, which is that the underlying forces still favor this low inflationary or deflationary condition, right? And so when we talk about the global inflation characteristics and the dynamics of outsourcing, where we decide that we're going to buy our TVs from China instead of having them manufactured in, Rochester, New York, right?
Yep.
Yes, that means that the price of the TV has fallen. But I actually would suggest that when we take those factories and we rebuild brand new technology factories and we put them in places like Rochester, we're not really going to be spending that much money on labor, right? One of the staggering statistics that I shared with people a couple of years ago is if I looked at the production, the single most expensive component in a flat panel TV is the glass, right? So the actual glass itself. Panasonic built a glass factory in Japan that makes glass for something like 30% of the world's TVs and uses 6 people. Right? Like, just stop and think about that for a second, right? 6 people in Japan make 30% of the glass that's used in televisions around the world. Right. And by the way, that factory is probably obsolete now.
Right.
Right. So this is why we can get 85-inch TVs for, $1,500 sort of thing, right? They were admittedly, 97% cheaper in 1900. That flat panel TV with an 85-inch screen was virtually free in 1900. That's a joke, obviously a bad one.
Yes.
The other thing that I want to point out to people is that the primary driver of inflation, we'll hear, the work quoted of Charles Goodhart or Eunice Aksoy, et cetera, it refers to the composition of population, right? So an aging population is supposed to be inflationary. All of those studies leave one really important point out, which is the way that they isolate for aging is that they remove population growth, because an aging population by definition is one that's not growing in population very much. Right. Not a lot of new births that are going into that. Therefore, the population is aging. And the single biggest determinant of inflation is actually population growth. It's really more precisely labor force growth, people deciding that they want to enter the consumption economy.
Yep.
If I look at, and I'll use my life here as I'm talking about the global population on the right-hand side. I was born in 1970. I'm now 52 years old. Over the 52 years that I've lived, the Earth's population has expanded by 4.2 billion people. Right, my life expectancy is somewhere around 94. Right, in the remainder of my life, right, which is almost the same quantity of years, the current expectation is that the world's population is only going to grow by 1.5 billion people. That means fewer dishwashers have to be produced, fewer TVs have to be bought, fewer cars have to be made, et cetera, et cetera, et cetera. Broadly deflationary or disinflationary conditions. I just continue to think that this is the core issue, except for the very obvious point that we can't seem to leave well enough alone. We've become truly interventionist on both sides. And, my partner, Harley Bassman, who I love dearly, will respond to charts like this where I point out, no, this really is a transitory inflation. I'll say, Mike, that's a 2-year period. When you said transitory, people thought you meant 2 months.
Yep.
And I'm like, all right, I can't actually explain why people would think that anything in macroeconomics, was 2 months in duration, right? These are very slow moving
I was
components.
going to make that comment as part of one of the questions I had for you was, one of the things I learned over the last 2 years is that there's a lot of different definitions for transitory.
Exactly.
But to your point, I think, our society is so immediacy now. And so
Yeah.
any definition, people want to see something happen much more quickly, where to your point, in a global macro environment, things happen very slowly over time, and then maybe all at once. But and I think all of what you discussed, I read a lot. I try to read as much as I can. I've read kind of all sides of it. Peter Zeihan in particular, he talked a lot about the demographics, and that
Yep.
particularly outside the U.S., it's much worse. We at least have a younger millennial generation, and
It's just very quickly, it's getting much worse than most models had forecast in the US, because we've also killed immigration, right?
Yep.
So the core difference between US population pressures that were forecast 5 years ago and what we are actually experiencing today has been the absolute collapse of immigration.
Yep. Yep. So, we're running up, we have about 5 minutes left. So I want to make sure I leave any time if there's any key areas you wanted to cover before we wrap up, that kind of lead into, I know we've kind of touched both sides of it. There's a lot of data pointing to we're heading to this recession. It's pretty much inevitable that we're going to end up in a recession. I know there's even lots of different definitions of what a recession might mean, but we don't have to spend a lot of time on that. But the likelihood is we're heading to something like that. But on the flip side, the market is not the economy, and that there's a colleague of yours, Mike Taylor, who runs one of your funds. He has a comment I've seen him make a number of times that don't worry about being right, focus on making money.
Yeah.
And so given that, kind of looking ahead in the next, as best you can with your crystal ball, what would be your final thoughts, words of wisdom for people positioning portfolios, thinking about, to your point, we could go either way. We could have enough recessionary effects that young people get laid off and flows start going the other way. We do end up in an 08, 09. Flip side, we don't, and we end up with a big rally. What do we do?
Yeah.
How do we position?
So I'd say that there's a couple of components, and even again, Harley, who has been astonishingly productive in the past year for introducing things like interest rate hedge products, etc. If he were running a hedge fund, he would be retiring in extraordinary style right now with the performance that product has experienced, and we've been thrilled to see people use that product in the right way. Among other things, I just want to emphasize that style of product where we've purchased a payer swaption, that is a hedge. Yep. It is designed to, you can use it to bet on higher interest rates, but broadly speaking, we want that product to be used as a hedge. And it's been really helpful for portfolios in that framework. If I'm correct and inflation continues to recede, the odds are very high that the Fed will pause. And that's one of the reasons, people will point to the next meeting and say, well, they're definitely going 75. That's fine. I actually am not going to dispute that. I made the joke in some of the writing that I do elsewhere that, we're breathlessly awaiting CPI reports of what happened last month so we can predict what the Fed is going to do next month, right? Seems like a very messed up world if that's, rather than trying to drive through the windshield, we're very clearly driving through the rear view mirror. I don't make the rules, I live by the rules and in the system in which they're defined. And so I think that is putting a lot of pressure on interest rates, but hopefully most of the stuff that I've shown today suggests that we're actually experiencing real value emerge in the bond markets. And there's the potential for interest rates to have to fall again significantly. Everything that I'm seeing suggests that we're going to create a significant enough slowdown in the equity markets, in the credit markets, and in the economy that the Fed will ultimately have to respond. And so I would argue that bonds are beginning to show absolute attractiveness, even if they may not be perfectly positioned to buy. This looks a lot like the fourth quarter of 2018 in that framework, where the economy is slowing, but the Fed is resisting it and basically looking at all the signs of financial stress and saying, we see none of it, putting fingers in their ears, closing their eyes and saying, I can't hear you, I can't see you, therefore you don't exist, right? Fans of the Hitchhiker's Guide to the Galaxy will know they've wrapped a towel around their head and the ravenous bug bladder beast, is not going to get them. Yep. Unfortunately, that's not how recessions work. The other joke I was just on stage with David Einhorn, and he had one of the best lines that I didn't manage to extract, and so I'm going to steal it from him, which is, they will figure out the definition of a recession this time, roughly around the time they figure out the definition of a woman. So we're in for an interesting experience. I think they're going to do everything they can to say it doesn't exist. And in England, for example, the Bank of England has actually called out, we expect a recession. I don't know that that's ever happened before in history.
Right.
So that's a really interesting dynamic. Taking Jerome Powell's pain comment to the next level. When the Fed does pause, for both the reasons of collateral that I showed you before, as well as a generalized sense of relief, I think the very real fear that we all have to be grappling with is if we go to try to buy and we're not yet seeing selling from the passive players, if the economy hasn't weakened to that point, who are we going to get to sell to us?
Yeah.
Right. And so I think there's a very real risk of an even more extreme bear market type rally, similar to the rally off the September 2001 levels, right, where we had been attacked, we moved into recession, and yet paradoxically markets rallied almost 50% over that time period, right? Just an extraordinary rally. I think a risk of something like that is very much out there. And so I'm being very cognizant of that in my positioning in my equity portfolios. The last thing I would just highlight is the US dollar. And again, here the real secret is that the Fed is engaged in extraordinarily tight behavior as collateral prices fall, whether that's equities, bonds, et cetera, real estate. The demand for dollars to meet margin calls, the demand for dollars to service debt as the economy slows, et cetera, all of that's creating a global dollar shortage that is exacerbating all the conditions that we have in the United States abroad. That doesn't go on forever unless we truly decide that we're going to exploit that American empire component, right? I referenced that potential risk before. I don't think we're going to get there. And I actually think that there's a very real prospect, just from a purely political standpoint, that the Democrats, who have broadly looked at the policies that Powell has engaged in and use that as a way to say, it's not our fault. The inflation we're experiencing is not a function of our fiscal profligacy. It's the Fed's fault. It's their job. They have to clean it up. That support could evaporate on the election.
Yep. Yeah. So I appreciate that. I think the thing what I'll wrap on and kind of close with that is, as we've seen is, as all the information you have ahead of you, still not sure which way this is going to go, right?
Absolutely no idea.
And none of us are in the business of predicting, where that,
especially about the future. I'm told it's really hard, right? So
yeah. So I'll steal a Chris Cole line, like I've stolen a few others too. It's not, we're not trying to predict, we're trying to prepare our clients for either way, right? And so having
absolutely
pieces in the portfolio, just like you guys do at Simplify, that can play offense and keep up when things are going well and that correlation switches, but having those defensive players on the field at all times in the right allocations so that if we experience the 0809 scenario, our portfolios are protected. I think that's the best we can do from our point of view in this environment, is not try to, and I know you're not doing it either, you're not trying to play one over the other, you're just prepared for either one of those routes.
In language you've heard me use before, the car is, as crazy as it sounds, the car is still driving uphill. Just wear a seatbelt.
Yeah.
Right.
Yep. I think that's great. Well, Mike, I appreciate your time. I know you're super busy traveling all over the country and often the world, and just appreciate you taking an hour and spending it with us and our audience. And once we get this recording edited, we'll make it available and make sure everyone has a chance to review. And for those of you who couldn't make it, also get a chance to review. But Mike, really appreciate your time and look forward to continue to work with you and Simplify and all the great work that you guys are doing.
Well, we really appreciate the support, and thank you very much for asking me on, and look forward to any questions that emerge from it.
All right. Appreciate it, Mike. Have a good evening.
Thank you very much, Homer.